Hey there. Today we're going to be reviewing chapters 17 through 20, covering banking services, consumer credit, investment strategies, and insurance. The Federal Reserve System was set up by the federal government to supervise and regulate member banks and help banks serve the public with more efficiency than they were beforehand. Commercial banks, also called full-service banks, because of the wide range of services that are provided. These commercial banks are the most common way for a bank to be organized in the United States. A credit union is a user-owned, not-for-profit, cooperative financial institution. People in the same company, agency, labor union, or profession often form these credit unions. The Federal Deposit Insurance Corporation, or FDIC, is the federal agency that helps regulate banks and other financial institutions. This protects depositors' money in the case of a failure of a bank. Safe deposit boxes are offered by banks for storage of valuables such as important documents, jewelry, or rare coins. Many people use these because of them being in secured areas, therefore being very safe. A service charge is a fee that a bank charges for handling a checking account. Most banks don't use these charges so long as the minimum balance is maintained in the account. A debit card or cash card is used for ATM transactions. This is different from a credit card by taking money directly from your account rather than borrowing money from the bank to later pay back. An endorsement is written evidence that you receive payment or that you transferred your right of receiving payment to somebody else. A check register is a separate book, usually the same size as the checkbook, that allows you to maintain a record of the checks that you have written. A stop payment order is used to tell the bank not to pay a check that has already been written. Banks charge a high fee for stopping payments on a check. Because of this, you must use this order cautiously. A bank statement is a status report on your bank account that is sent to you normally monthly, giving you information about your balance, deposits, or interest for your account. Bank reconciliation is the document created to show how the two balances were brought into agreement. The bank often prints forms of reconciling on the back of bank statements. Outstanding checks are checks that haven't been deducted from the bank statement's balance. Credit is defined as the privilege of using someone else's money for a period of time. This is based on the belief that the person receiving credit will repay the amount owed at a later date. A finance charge is added if the amount owed is not paid. A finance charge is defined as the total dollar cost of a credit including interest and other additional charges. A down payment is a payment of part of the purchase that is normally paid at the time of purchase. An installment loan is a loan in which you agree to make monthly payments in specific amounts over time. These payments include the amount borrowed plus finance charges on your loan. A promissory note is a written promise to repay based on a debtor's excellent credit history. The amount borrowed, along with some interest, is due at a certain date. Collateral is property offered as security for a loan. This may include a car, house, or even jewelry. This gives the lender the right to sell this property to get back the amount of the loan that was not repaid. The cosigner of a note is responsible for payment of that note if you do not pay as promised. This normally occurs if you don't have property to offer as collateral, but a relative or a good friend does. A credit rating is simply defined as a person's reputation for paying bills on time. This is very important when you need to borrow money or make a major purchase to show that you can pay it all off. Interest is the cost of using somebody else's money. To determine the amount being paid on a loan or charge, the principal, rate, and time must be understood. The annual percentage rate, or APR, is a disclosure required by law that states the percentage cost of credit on a yearly basis. A credit application is a form on which you provide information needed by a lender to make a decision about granting credit. Some companies also take online applications in addition to the printed one. A credit bureau, also known as a credit reporting agency, is a company that gathers information on credit users. This information is then sold to businesses in exchange for credit. The statement of an account is the record of the transactions completed in the billing period. This normally includes the balance, amount charged, amount credited, current balance, and minimum payment due. A credit counselor discusses and suggests actions to take to reduce spending and eliminate credit difficulties. Bankruptcy is defined as the legal process of reducing or eliminating an amount owed. This process is expensive and requires legal assistance, but this can be avoided by practicing sensible money management. Saving is the storage of money for future use. How much you save, where you put your savings, and what you save for are all important decisions. Investing is simply defined as using your savings to earn more money. There are a multitude of investment choices, but a savings plan is the most simple. Yield is the percentage of money earned on your savings or investments over the period of 1 year. This is also known as the rate of return or annual yield. Liquidity is the ease with which an investment can be changed into cash without losing its value. Investments that can quickly be turned into money are known as liquid investment. Preferred stock has priority over common stock in the payment of dividends. These dividends that are paid to the preferred stockholders are normally limited to a set rate. Common stock represents general ownership in a corporation. With this ownership comes the right to share the profits. However, there is no dividend rate like there is with preferred stocks. A stockbroker is a licensed specialist in the buying and selling of stocks and bonds. Stockholders go through these brokers to sell their shares, while interested buyers go through these brokers to buy shares. A stock exchange is a business organization that accommodates the buying and selling of securities. More than 170 stock exchange businesses exist around the globe. The market value of a stock is the price at which a share of stock can be bought and sold for in the stock market. This indicates the value of a share of a stock at a point in time. Municipal bonds are bonds that are issued by local or state governments. The interest earned from these bonds are exempt from federal and most state income taxes. Corporate bonds are bonds issued by corporations. This is not to be confused with investing in stock, which is buying ownership. Investing in bonds is lending money to be repaid later. A mutual fund is an investment fund set up and managed by a company that receives money from many investors. This is managed by a professional that uses the investor's money to buy and sell stocks or bonds. Real estate is land and anything that is attached to that land. This is one investment that many people will eventually acquire. This normally means finding a place to live. A mortgage is a legal document giving the lender a claim against the property if the principal, interest, or both are not paid as agreed. This is used to borrow money to buy a house. Equity, in a real estate context, is the difference between the price at which you could currently sell your house and the amount owed on the mortgage. This builds up over the years, increasing rapidly over the last few years of a mortgage. Assessed value is the amount that your legal government determines your property to be worth for tax purposes. This value is normally around half of what the market value is. Commodities include grain, livestock, and precious metals. These commodities are considered speculative investments, which means investments with unusually high risk. A futures contract is an agreement to buy or sell an amount of a commodity at a specified price in the future. This also involves the buying and selling of currencies and financial instruments. Collectibles are items of personal interest to collectors that can increase in value in the future. This type of investment is popular with many people. Bodily injury liability coverage is insurance that protects a driver from claims resulting from injuries or deaths for which the insured is at fault. Medical payments coverage is what is used to cover policyholders and family members if they are injured while riding in their car or another car. This may also include if you are walking and get hit by a car or cover guests inside the car. Uninsured motorist coverage is used to protect against drivers that cause injuries due to a hit and run or drivers without insurance or money to pay claims. Collision coverage is insurance that protects a car owner against financial loss resulting from a collision or rollover. However, this does not cover damage to property or injuries. A deductible is what you must pay before the insurance company will pay for a claim. These deductibles also decrease premium costs. Depreciation is the decrease in value due to the age of an item. This decrease may affect the amount an insurance company will pay if the property is destroyed. Hospital insurance usually pays most, if not all, hospital charges in the case of an illness or injury. This may cover anything from food costs to anesthesia. Regular medical insurance covers fees for non-surgical care given in the doctor's office, patient's home, or hospital. This is for care provided by a physician that could be expensive. Coinsurance is the sharing of expenses by the policyholder and the insurance company. The policyholder typically pays a deductible, sharing the remaining cost with the insurance company.